we're going to talk about something that is big. And when I say big, I mean really big. Like beyond big. Like, birth of a child, big. Marriage, big. This is big, big. This is the emergence of a new financial system and what we call crypto capitalism. So the fact is, if you ask the old guard on the right-hand side of the left, what their favorite assets are, it's stocks, bonds, and cash. We like our stocks. Well, if you ask anybody under the age of 30, what percentage of their net worth do they have in digital assets, it would make you throw up. It's 50, 60, 80, 90%. So they don't have stocks, bonds, and cash. They don't have brokerage accounts. They are living in this new digital world already, and we all need to catch up. And so crypto capitalism is actually a game on the internet now. So the purest form of insanity is to leave everything the same and at the same time hope that things will change. The illiterate of the 21st century won't be those who can't read. They'll be those who cannot learn, unlearn, and relearn. The most important thing we're going to do today is unlearn all the bad habits that you have, that I have, that we share, and so we can be poised to relearn. The most important task is to think in a new way, not to think outside the box, to think like there is no box. The box is gone. The box needs to go away. Times have changed. Learners inherit the earth, while the learned, those who think they're really smart, find themselves beautifully equipped to deal with a world that no longer exists. Most important quote of the whole day. We all know everything about our business, about financial services. Everything we know is being blown up right in front of our eyes. And if we don't change, we will inherit this world that no longer exists. I would say it's kind of like, I talk about Americans and stock owners. They're like Notre Dame football fans, right? They remember a past that never was. People say, what? People at Notre Dame think that Notre Dame wins the championship every year. We haven't won since '88, right? But my father-in-law thinks they win every year. Well, why does he think that? Well, when he was there, they did. They went 4 years undefeated. From 46 to 49. They won 3 national titles. How'd they do that? Well, the coach went to Europe during the war and got all the guys to come back from Army and Navy as 28-year-olds and had a semi-pro team for 4 years. You don't get to do that anymore except at BYU. So the key is that you all have to unlearn what you've learned. Because capitalism is liberating best in a non-capitalist environment. The crypto businessman is a revolutionary in a communist country. And we'll see what that means here in a second. So every January I steal the saying, good artists borrow, great artists steal, so said Picasso. So I stole this from Byron Wien, and I do my 10 surprises just like he does. And my 11th bonus surprise this year was that blockchain hits the big time. Truly disruptive technologies cause great angst. They make people very nervous, and particularly the incumbents, right? Never, ever ask an incumbent what they think about new technology. Everyone knows why stoops in downtown New York are 9 feet off the ground, right? Because of horseshit. Because the street sweepers would push the horse poop to the side and it would stack up, and the women didn't want to drag their dresses, so they built the stoops and the sidewalks 9 feet above street level. Okay, so when the horseless carriage came out, what did the street sweepers do? They passed out pamphlets saying, if you drive in a horseless carriage, you'll die. When the electric light bulb came out, what did the candle makers do? They passed out pamphlets saying, if you use electric light bulbs, you'll go blind. Probably reading by candlelight made you go blind faster than the electric light bulb. So incumbents are never the ones. So you should never ask Jamie Dimon what he thinks about this new technology. He called it a fraud, right? Financial services guys called it fraud. Governments called it a threat to national security. China banned crypto. So what happened? The crypto exchanges picked up and went to Japan. Japan waved them and said, hey, we'll tax them, bring it. So you can't ban a decentralized thing, which we'll talk about. The reality is, it's not a fad, it's not a bubble, it's not a Ponzi. If you call it a Ponzi scheme, it just means you don't understand the meaning of the word Ponzi scheme, because it's nowhere close to a Ponzi scheme. So it's big, really big. Now, 190 days after Jamie Dimon called it a fraud, his own firm issued a 170-page report saying it's real. Okay, Goldman Sachs says it's pretty good. KPMG, I'm going to go speak to their partners tomorrow about it in Dallas. at their partner meeting. They think it's pretty cool. DTCC, of course, they're worried about it because they're going to be completely displaced. But people think this is real. Now, what's really cool is on the far left, The Economist magazine. This is a real cover from 30 years ago. Okay? Last time we won the national championship at Notre Dame, okay, this cover story of The Economist predicted that there would be a global currency called the Phoenix. And if you look at the coin, it says 2018. That's kind of spooky, right? Now, for 20 years, nothing happened until Satoshi-san came along and said, hey, I got this idea called Bitcoin, and we will create the first global currency that works, and I'll explain why in a little bit. And then this year, it's the future of money. Now, what I find interesting is why is it always a gold coin? There's no gold, and there's no coins. It's like calling Madoff a hedge fund scandal. There was no hedge, and there was no fund. Right? The guy hadn't made a trade in 13 years, and there was no actual fund. He was just transferring money into his personal account. So to call this coins is wrong, but it's something bigger and better. Now, change is hard. None of us like change, particularly those whose livelihood is going to be disrupted. So we have denial, we have anxiety, we have shock, we have fear, we have anger, and we lash out against the new technology. But those who cannot change their minds can't change anything. So you have to unlearn all the things you think you know, right? It's not what we don't know that kills us. It's what we know that just ain't so. So digital disruption is already happening. The largest transportation company in the world owns no cars. We all grew up saying never get in the back of a stranger's car. We do it every single day. We encourage our daughters to get in a car with a stranger because it's safe. Why is it safe? Because of trust. Why do we get trust? We'll talk about that in a second. So the largest accommodations company in the world has no assets. They have no hotel rooms. Every day, millions of people stay in Airbnbs around the world. Think about that quote on the bottom right. Within 5 years, 40% of incumbents will be disrupted. 40% of incumbent companies disrupted. Digital technology is not new, right? It's been going on for a long time. Upper left-hand corner, my dad used to install big iron. He used to install those big IBM machines that took up a room this big, okay? That's what he used to do. Then he bought me one of the first Apple leases. I should have kept it as a collector's item. And then my first job, I got one of those IBM PCs, but then I upgraded. I bought one of the very first PCs, limited PCs from Michael Dell from his dorm room at Texas. I should have kept that as a collector's item. Now, why did I buy that? Because I trusted PC Magazine because it gave him the Editor's Choice Award. It only took 10 years until I figured out that Michael Dell paid them to get that award. Genius. Okay? But I trusted PC Magazine incorrectly because it was a fraud. Okay? They got paid to give people those awards. Whoever paid them the most sold the most PCs. And then that actually is the first computer that I took to Notre Dame back in I guess when I went, in 1981. So I took that K-Pro computer. It ran on something called CP/M. Better operating system than DOS. True story. IBM went to Seattle to try to look at DOS. And they stopped in. They saw Bill Gates, who was 19. They thought he was the coffee boy. They left, went down to California to meet with the guys who founded CP/M, a husband-wife team. The husband said, I will not meet with them because they won't sign my NDA. IBM said, bye, went back to Seattle, signed on DOS, and that's why our computers crashed all the time. Because CP/M was really good. DOS sucks. So how many of those phones have you had in your life? I've had almost every single one. I didn't have the original brick. $3,995 was a little stiff back in the 1980s. All right? That's $3,995. And remember the first month it came out, they said it gave you brain cancer. So all kinds of bad stuff. But, you know, Gordon Gekko still had it on the beach. But I've had most of those other phones. And I actually went to the birth of my daughter with all of that stuff. Okay? I went to see my granddaughter with a phone. But I had all that stuff. I had a Palm Pilot, believe it or not. I had a Walkman. I had all of those things. Now, what we're talking about here is really simple. It's technology. Blockchain is technology. It's not a thing. It's not a speculative thing. It is technology. And it has to do with connectivity. So back at the beginning, in 1950s, there were no connected devices. Those big IBM machines were solitary and isolated. Okay? Then we had this thing called the internet that came along, and we had some connected devices. By 2020, there'll be 200+ billion connected devices. Just let that sink in. That's 30 for every man, woman, and child on the planet. Think about what that means, because that means we can't do it with client-server technology. We can't do it with open network cloud. We need a new distributed system. And so we are about to enter the 6th epoch. Okay? We had the Industrial Revolution. We had the steam engine. We had the information age. The blockchain era is coming, and it all has to do with the green stuff at the bottom on the right. This is technology. It's a 14-year cycle. Why is it a 14-year cycle? I actually have never figured that out exactly. I think it has to do with the creative class, and it's always young people that innovate. But it's 14 years. 1954 was the mainframe. Okay? Then you had 1968 with the microchip. Then you had 1982 with the personal computer, 1996 with the internet, 2010 with the mobile net, and 2024 is the trust net. My word, use it liberally. Okay? The internet of value, the internet of things. I call it the trust net. I'll explain why. So blockchain is really simple. It basically is a distributed ledger using cryptography. We use consensus and smart contracts to do things like reduce cost, increase security. We make it more auditable. We make it more resilient. It is better technology. This is about technology. And this is my son's, I have a 7-year-old, this is my son's Monopoly game. I love it, Token Madness. So in playing Monopoly, you've all played Monopoly before, right? There's a banker. And the banker, when you're handing out the money, two bad things can happen. One, you can make a mistake, right? The money sticks together. Or you can just cheat, right? You give yourself an extra 500 every time you go around. So that's bad when there's a centralized banker. Now, if we all decided to play Monopoly, and we just decide we're all going to allocate tokens, and then Sam lands on Allie's property and has to pay the tokens, we all write down on a ledger what we think everybody has in this room. We all give a thumbs up. And that is a better way of auditing the system rather than have a single centralized banker be in control. Now, there's the far left, the centralized systems, and there's decentralized, and there's distributed. And you think about it in this two-dimensional way. Everybody thinks about it in a two-dimensional way. So you think about architecturally centralized, physical locations, like a corporation, right? One physical main office. Except if you're Amazon, then you split the second one in half. I'm like, well, then, is it really HQ2? But it's weird. But then there's politically centralized, right? A perfect example of that is the corporate office, right? One CEO, one home office. Now, how do you kill a centralized organization? You blow up the main office or kidnap the CEO. And I don't mean that literally, like acts of terror, but that's how you would do it, okay? That's easy to kill off, right? Napster was the first decentralized system in theory, but actually wasn't decentralized, right? It was file sharing, but it really wasn't. It went through one server and it had one CEO. So when the government wanted to shut it down, they arrested Sean Parker and trashed his servers. And that was the end of Napster. So centralized is easy to kill. Blockchains are decentralized politically and architecturally, but there's a third dimension that's important here. So I'm having a conversation here with you in English. My wife back home is having a conversation with our 7-year-old in Spanglish. It's not exactly English because he's bilingual, we're not. I'll say, Will, ¿cuánto? So I'll say 3. I'm like, no, en español. He's like, Dad, you don't speak Spanish. He does. So, because his babysitter's spoken to him since he was 5 weeks old. So that has a different way of thinking about logically centralized or decentralized. Language is logically decentralized, meaning there can be variance around the world. In common law or in blockchain, we want a centralized philosophy, even though we want decentralized architecturally and politically. So you guys know how blockchain works. Two people decide, we give consensus, and only after we all give consensus does the transaction actually occur. Now, what is it good for? It's good for everything. There is not a business model on the planet that will not be impacted by blockchain. Not one, right? Everything from voting, okay? 51% of people didn't vote in the last election. That's not the one we just had, but the one in 2016. That's just wrong on every level. It should actually be a requirement. You shouldn't be able to get your driver's license or something unless you vote. And it should be as easy as pushing a button on your phone. Perfectly encrypted, perfectly soft. Not like Chicago, vote early and often. Okay? Not like Florida where votes vanish. Let's just have one man, one vote, one woman, one vote, really easy. How about travel and hospitality? How about insurance? How about health care? How about you own your data? Anyone done 23andMe or Ancestry? You think you're getting this deal, you put in your DNA and you pay $49 and they tell you that you're, 4% this and 3% that. You can think you're getting a deal, right? They then sell your DNA for thousands of dollars to the pharma companies, okay, because we gave it to them. Or anybody use Facebook? Okay, you think it's free. Anything that's free, you're the service. So they take your data and they sell it. How about if we own that data? Blockchain allows us to own our data and get paid for it. So this is the most memorable thing I'll say today, hopefully. This is the biggest wealth creation opportunity any of us in this room will see in our lifetime. I'm going to say it again. Blockchain technology is the biggest wealth generation opportunity that any of us will see in our lifetime. And it has to do with the decentralization of trust and the flow of value between individuals without intermediaries, getting rid of the rent-seeking middlemen. These two things, these two simple concepts, are so big that it will create more wealth. The first $10 trillion company will come from blockchain. The first trillionaires will come from blockchain. These are big, big concepts, and they're all in front of us, not behind us. Why? Because on the web, Tim Berners-Lee, anyone know who Tim is? He actually invented the internet, okay, not Al Gore. Okay, Tim Berners-Lee invented TCP/IP. Now, Vint Cerf says he did, but I think Tim Berners-Lee did. Tim invented TCP/IP, but Tim isn't a rich guy. Zuck is the rich guy because Zuck gets paid for you using his service. Tim, every single day, there were 85 protocols in the internet back in the 60s and 70s. Today, there are 5 that matter: SMTP, HTTP, TCP/IP. That's it. And those supercomputers on everybody's table, okay, that supercomputer in your hand is more powerful than the first PC I bought from Michael Dell, 100 times more powerful. And it uses TCP/IP, but the application layer captured all the value. Blockchain inverts the value capture, and the protocols actually capture the value. It took IBM 40 years to get $100 billion of value. Bitcoin blockchain has done it in 10. 10 years to get $100 billion of value into the protocol. That is the magic of blockchain. Now, the internet of money, or the internet of value, or as I call it, the trust net, is the biggest opportunity any of us will see in our careers. And it has to do with taking things in the green box: fiat money, shares, bonds, derivatives, property title, elements, everything of value. Everything of value, everything in the world that has value will be tokenized and will end up on blockchains. All of it. And it's the biggest opportunity we will ever see. Because distributed ledger, not new technology, right? We had ledgers for thousands of years. You used to have these things called tally sticks. Back in the 1800s, if you were a really wealthy guy, because women couldn't own property, if you were a really wealthy guy, you had this big thing of tally sticks. Well, what were those? Well, when you lent somebody money, you broke a stick in half, you carved a notch on it, and you kept your side, and that was your record. That was your dual entry accounting ledger, because there were no ledgers at that point. And then what happened is when the debt got too big and the UK government said, we can't handle this, so we're going to burn all the tally sticks and erase all the debt. They did a debt jubilee. Another one's coming, first in Japan, then Europe, then the United States. But that happened in 1864. The funny thing is they actually burned down Parliament when they did it. Right? They stuffed them all in the furnace and burned down Parliament. But they then adopted the Medici's dual entry ledger. Okay? And now we use dual entry accounting. And now that's all going to go away. And we're going to have 3-entry tri-ledger accounting, which is what distributed ledger technology is all about. So this is not new. 1988, this guy named Tim May wrote the Crypto Anarchist Manifesto. He predicted everything that would happen over the last 30 years. That's where the article in The Economist came from. And what's amazing is when you read his Crypto Anarchist Manifesto, it's only 1 page, okay? You say, wait a minute, that happened, that happened, that happened. Well, why didn't it happen faster? Well, it turns out anarchists don't have friends. Okay, so they don't influence people. So it took 20 years for Satoshi to come along and actually create Bitcoin. But then you got all these guys, the haters gonna hate. Why does Jamie Dimon call it a fraud? Why does Warren Buffett say it's like rat poison squared? How do you know what rat poison tastes like, Warren? Unless you're a rat. Okay, and then Charlie Munger one-ups Warren and says it's like trading harvested baby brains. Charlie, what the fuck? Seriously? What? Now, who are you going to, this is called the Tale of Two Charlies. Who are you going to listen to about blockchain and Bitcoin? Charlie Munger. I'm being generous, saying he spent 10 hours thinking about Bitcoin and blockchain. Or Charlie Noyes, who spent 10,000 hours. And anyone who knows Charlie Noyes said, no, that's impossible. He's only 21 years old. Well, let me describe Charlie Noyes to you. When he was 9, he started coding. When he was 11, he started mining Bitcoin. When he was 14, he won the national competition on distributed ledger technology paper, beat Caltech and MIT students. When he was 17, got a full ride to MIT, came after one semester, went to the dean and said, this is too easy. Can I just take a test, get my degree? Dean said no, dropped out, went to California, joined Pantera, then just got recruited away to go work for Paradigm. So I'm going with Charlie Noyes. He just knows way more than Charlie Munger. But consider the source. Why did Charlie and Warren want you to hate Bitcoin? The same reason they want you to hate the XL pipeline. Why did the XL pipeline never get passed? Because they own all the rail cars doing the oil. That's why the XL pipeline doesn't get passed, because they pay off politicians to get it not passed. Same thing's true here. 46% of Berkshire Hathaway is financial services. So they don't want Bitcoin and blockchain to be successful. They don't want you to like it. They don't want you to understand it. They want to tell you it's rat poison and dead baby brains. Stupid. So centralized versus decentralized. Centralized systems are not fault tolerant. They're not resistant to change. They can be hacked. All the big hacks happen at centralized systems. Decentralized systems don't get hacked. So we've had people try to create digital currencies in the past. Okay? eCash, eGold, Liberty Reserve. Why did they fail? Because they have a single point of failure. They were like Napster. They had a single point of failure. And you can shut down any centralized system. So what happened is we needed someone to come along and out-engineer the single point of failure problem, which has to do with decentralization. And that's the genius. Look, it's only 19 pages. But it's like reading a Beethoven symphony or poetry or Shakespeare. Satoshi white paper is amazing in its elegant simplicity. And it created, for the first time, a viable way to have money, programmable money. And so what we have is blockchain establishes a single point of truth. That's why we call it the trust net. This is all about truth and trust. Because we don't need a third party to establish that trust. Because if there's a third party establishing truth, that third party can cheat. If there's a single point of truth between two people exchanging value, no one can cheat. Okay? The banksters can't steal your money. The banksters can't get bailed out. Remember, by the way, your money that you deposit in the bank is no longer your money. You now have an IOU from a financial intermediary that if they default, you lose your money. Oh, but it's insured. Well, up to $250K. But if you got more than $250K in the bank, it's not yours. That sink in for a second. So history of money, been pretty good up until 1971. Pre-1971, money was sound. It was commodity-backed. There was gold or silver, the pound sterling, a pound of sterling silver. Okay? There was value behind it. 1971, the Fiat fiasco, we went to fiat currency. Fiat currency has no value. Fiat currency has no value. On the back of your little green piece of paper, it says, "In God we trust." And you better hope God's listening to your prayers, because there is no value. You couldn't hand that to the government and get anything for it. Oh, it's backed by the full faith and credit of the government. No, it's not. It's backed by nothing. It's backed by trust between two parties to exchange value. So since 1913, it's been worse. Because there's this little thing. So these trust companies started popping up in the 1900s, and they were threatening J.P. Morgan's dominance in banking. So he went to his friend John D. Rockefeller, and they said, hey, let's plant a story about these bad guys at the New York Trust Company, and they'll trigger the run on the bank in 1907. So they had the Great Panic in 1907, the Knickerbocker Panic, and the trust companies all had to shut down. And who was there to bail them out but J.P. Morgan and John D. Rockefeller? They wrote a $25 million check. And then John D. Rockefeller's father-in-law, it turns out, like Warren Buffett's dad was a senator, a congressman, very powerful congressman. John D. Rockefeller's father-in-law, it turns out, was a senator named Aldrich who created the Aldrich Plan that created the Fed. And since 1913, from 1776 to 1913, a dollar was worth a dollar. Fancy that. It was worth a dollar. And since 1913, it's down to 3 cents. Because it turns out you can't outrun inflation if you have income. The reason we have the highest wealth inequality and the highest income inequality in the history of mankind is because this is the dictator playbook. You accumulate all the assets, you deflate your currency, so the asset values increase, but people who are on income lose. The best way to destroy a capitalist system is debauch the currency. Okay? Anyone who allows the government to control the currency gives up their livelihood at the power of the elites. So the purchasing power of a dollar, okay, back in 1971, before we went to Fiat, you could buy 4 loaves of bread. Today you could buy half a loaf of bread, or in Santa Monica, a quarter, maybe a piece of bread. Okay? Pretty expensive out there. So anyone realize that Zimbabwe 2 years ago was the best performing stock market in the world? Why? And actually, back in 2009, it was the best foreign stock market too. Why? Because they were devaluing their currency. I actually have that as a picture of my 100 trillion Zimbabwe dollar bill. Wouldn't buy a loaf of bread. 100 trillion. Okay, come on. Someone shudder when I use the T word. Trillion. I'm going to lock those doors. I'll make you sit here with me for 31,710 years, which I promise would be most unpleasant. And you got to spend $1 a second. That's 1 trillion. Not 100, 1. $1 trillion, dollar every second for 31,000 years, 1 trillion. So this isn't good. But then last year, Venezuela, best performing stock market. Anybody buy Venezuelan stocks last year? Anyone? No. Why? Because Maduro, okay, he owned all the assets, so he devalues the currency, he gets rich, and the people starve. This is how it works. This is the dictator playbook. It's happening all over the world. It's happening right here in the good old US of A. I went to lunch in Chapel Hill the other day, just me, right? Not a big party, just me. $18 in Chapel Hill for lunch. What? Didn't cost that 5 years ago. We are being slowly boiled like frogs, and there's only one solution, sound money. So what's happening is around the world, Turkey, Romania, Poland, Spain, all these other countries have realized the value of Bitcoin as sound money. So what's happening is Venezuela used to have no Bitcoin. Now they got lots of it, $3 million a day. Same thing in Argentina, same thing in Brazil. All the places where the dictators are taking their value, they're embracing sound money. Now, why does crypto matter? Well, one, no fraud. The Bitcoin blockchain, hundreds of millions of transactions over the last 10 years, never one fraudulent transaction, not one. Anyone here had to change their value or Visa or MasterCard number because of fraud? I've had to do it twice this year already, okay? That's fraud. Happens every day because they're centralized systems. A decentralized network, no fraud. How about identity theft? Anybody been SIM swapped? By the way, if you use two-party authentication and you use your cell phone number, change right now. Never use your phone number, because what they'll do is they go to an AT&T store, they pay off the clerk to give them a SIM card, they steal your number, and then they steal everything on your phone. Whether it's brokerage accounts, bank accounts, cryptocurrency, hundreds of millions of dollars. Use a second email address for two-party authentication. That's happened to me twice already. And I didn't even use my phone number, but they still got it somehow. So how about access to everybody? We'll talk about that. How about low fees? How about the fact that if you were going to commit a crime, everybody says, oh, cryptocurrency is only used by the bad guys. Every new technology in history has been used by the bad guys. Who are the first people to use pagers? Drug dealers. Who are the first people to use cell phones? Drug dealers. Who are the first people to use crypto? Drug dealers. Then the rest of the world catches on. Anyone have a cell phone? Y'all drug dealers? Some people in this room have 2 cell phones. Double drug dealer. So the key is, what makes a currency a currency? Everybody says, crypto has no inherent value. Of course it has no inherent value. Money does not have inherent value. Pull out a piece of green paper, look at the number on it. Some say 20, some say 10, some say 50, some say 100. It has no value. It's all the same. It's just linen. It's not even paper. It's linen and cotton. Okay? But in China, they like red paper instead of green. I was in Israel earlier this year. They like yellow paper. It all has to do with trust. So everybody says that crypto doesn't have any inherent value. Of course it doesn't. It's based on a system of trust. That's what money is all about. Everybody says, look, I use the Saudi analogy, which is less good since Saudi's such bad actors, but Bitcoin is king, Ethereum's the crown prince, and there's a whole bunch of princes that hate each other, and most of them are going away. Now, this is the problem, is people conflate the term cryptocurrency and utility tokens, which we'll get to in a second. This is my other one. Nobody uses Bitcoin anymore because the mempool is jammed. That's like Yogi Berra saying no one goes to the restaurant anymore because it's too crowded. So last December, people said Bitcoin was a bubble. And they used to send this all over Twitter. They sent this picture on the right. Now, it's the same thing they said back in 2013. So see, back in 2013, they said that was a bubble, okay, when Bitcoin got to $1,000. And then it fell, and it went down to $400. And I wrote about it. I write these long quarterly letters. I wrote one paragraph in a 65-page letter, and I had clients say they'd fire me. I'm like, why? You shouldn't talk about this crazy stuff. This is ridiculous. This isn't real. This is magical internet money. Well, it was $400. Now, it did go to $177, but today at $6,500, it's materially higher than $400. So it's been a pretty good investment. Beats all other investments, actually, over that period. All other investments, every single one. But that's not the point. The key is, this is the most important slide in the whole deck. There's nothing more important than this. For 5,000 years, 1 ounce of gold bought a fine man's suit. 5,000 years, 1 ounce of gold bought a fine man's suit. It's the perfect store of value, okay? But go to Savile Row today, a fine man's suit costs $1,200, $1,300. That's where gold is, surprisingly. So then in 1971, okay, Nixon screwed it all up, and we went, and that's not a political statement. He just happened to be the guy. Now, he did it because of other powerful forces, but he screwed it up, and now fiat money is going to be replaced with cryptocurrency, because cryptocurrency is sound money. And all this volatility, right? Bitcoin's a bubble. It went to $100, and then it went to $10, and then it went to $1,000, and it's crashing, and then it went to $10,000, and it's crashing. You can't see the volatility because that line on the left is embedded in the blue line on the right. That slow S curve is what's coming for crypto. It's going to eventually be global currency. So crypto is the little yellow, black, and blue dots up there. You got individuals with more money. The 50 richest people got way more than all the crypto put together. Then you got California's GDP, where I just was. Then you got all the currency in the world. Then you got all the gold in the world. Then you got all the stock market value. Then you got global money supply. How about debt? How about derivatives? Okay, derivative markets are pretty big. Remember, this is Bitcoin. Those are the derivative markets. Those derivative markets are probably not all going to pencil out equally. So sound money is probably a good bet. Now, the reason that most people can't understand Bitcoin and cryptocurrency is because they can't do math. And it's not a criticism. What's 2 times 2? 4. 17 times 23. More than 4. That has been proven to be the upper bound of human intelligence. Seriously. 17 times 23 people can't do in their head. So do you think you can do nonlinear logarithmic regression in your head? Probably not. This is called Metcalfe's law. So Metcalfe's law follows this nonlinear logarithmic projection and parabola. And basically, this guy put this model together in 2014, and he predicted that in November of 2017, the value of the Bitcoin blockchain, the network, would be worth $10,000. He was off by 6 days. Now, when the price got to $20,000, we tweeted out that the price was now stupid, because remember, price is not value. Value is the sum total of goods and services sold by a company, or the underlying cash flows of a piece of real estate, or the network value is determined by the number of users and the proximity to each other, et cetera, et cetera. All the things that go into Metcalfe's law. And so we think that by the end of this year, it'll be in the high 20s. By the end of next year, 67, 70,000, and then it goes on from there. So these parabolic moves and corrections are normal because what happens? When you have a big parabolic move, two things happen in first quarter. One, you have taxes that have to get paid, okay, in the US. And then two, you have Chinese New Year and people collect their profits to spend. So people are focused on the collapse since last December. Okay, that's just cherry picking data. What they should be looking at is the parabolic moves and crashes followed by another parabolic moves, which means sometime next year we should see new highs. Now, blockchain really came about because of trust or lack thereof. So basically, the millennial generation doesn't trust financial institutions. They don't like the banks. They don't trust the banks. They don't like brokerage accounts. They don't have brokerage accounts. They don't trust the brokerage firms. They trust themselves, and they trust this magic internet money. So the system was breaking down, and the digital age allows us to capitalize on the benefits of blockchain technology. So think about the first time you used email. Anyone old enough to remember sending a letter? You wrote a letter, you put it in an envelope, put a stamp on it, and you put it in this mailbox. 3 days later, somebody got it. It took them a day to respond. 3 days later, you got it. So a week went by before you had a communication. My wife can't wait 7 seconds for text reply. Okay, not a week. Think about this. What did you have to do if you wanted to make a copy of that letter? You had to find a Xerox machine. You had to pay a dime. How about if you wanted to make 1 million copies? That would take a long time. How about if you wanted to change it? Remember whiteout? Put that whiteout stuff on there. It got people high. Okay. Or how about if you wanted to send different letters to different people? You had to cut and paste, hence the term cut and paste. So when the email came along, when Tim Draper invented email with Hotmail, now suddenly we could digitize that information. And what email did for information, the mobile net did for e-commerce. 750 million people bought stuff with their cell phone last year in China, 250 million people in the United States. Now, blockchain will do this for financial services. So IMF says there's $1.7 trillion up for grabs in inefficiencies and wasted money that the banks collect because they're greedy. Why does it take 2 days to settle stock? If I sell stock to this fine person right here, it should happen instantaneously on the blockchain. It shouldn't take 2 days. Why does it take 2 days? Because there are 7 systems. All those 7 systems have to reconcile. Everybody's taking a cut. Everybody's taking a commission. Everybody's taking a piece. That doesn't need to happen. It takes 30 days for a bank loan to settle. Are you kidding me? 30 days? How many people have their hand out for that? So this all goes away. 1.7 trillion up for grabs. But it's not just banks. We have to ask the question, blockchains like the internet changes everything. What about the end of banks? What about the end of central banks? What does this mean for regulators? These are questions we have to ask. Blockchain technology will radically transform the financial services industry. In fact, the WEF this year said it will become the beating heart of the new financial system. Blockchain technology will be the beating heart of the new financial system. Now, banks have been under attack for a long time because banks actually don't do what banks are supposed to do. They don't actually lend money anymore. Banks borrow from the Fed and invest in treasuries. You know how many negative trading days JP Morgan had last year? Anyone ever traded? Do you make money every trade? I never have. JP Morgan had 0 negative trading days last year because they borrow from the Fed and buy treasuries. That's riskless, and you can lever that up, and you can have 0 negative trading days. So the banks don't lend money. So what happens is these peer-to-peer exchanges, these fintech companies are coming at it from all sides. But what if we don't need banks? I'm actually on the waiting list for this thing called GECO. GECO, think about this. Why would you give your money to a bank, and they pay you nothing, and they use your money? It's now their money, actually, it's on their balance sheet. And they take it, and they use it, and they get paid for it. Why would we do that? Why don't we have our money on a blockchain, private blockchain, and I can decide how I want to invest it, if I want to lend it. I can do all kinds of stuff with it. So GECO will exist. But here's another problem. 40% of adults in the world don't have a bank account. But 2/3 of those have a cell phone. So we can create apps that allow them to lend to each other, to transfer value between each other. They don't need to have rent-seeking middlemen taking a cut. We can bank the unbanked, 40% of the world's population. Pretty good idea. So what will happen to the banks? Well, the role of a bank, payments, credit, custody services, investment management, the bank used to be that provider of trust. But now blockchain comes in and with smart contracts and mutable data, it's a better system for trust. I trust data more than I trust banks. Anyone follow that thing over in the UK? I mean, not in the UK, over in Europe, where the bank laundered $230 billion? How many fines has JP Morgan, Bank of America paid in the last 10 years? Billions and billions of dollars. Stealing money, Wells Fargo making fake accounts. Do you trust that, or do you trust the data? So what's going to happen is the bank will be split in two. They'll become service providers and asset custodians, but all the transactions on the left-hand side will go peer-to-peer. Once we establish that single point of truth with blockchain, we can exchange value seamlessly peer-to-peer. So crypto assets will become the components of banking 3.0. There's only 4 assets in the world: stocks, bonds, currencies, and commodities. Today we have cryptocurrencies, we have crypto commodities, we will have crypto equities and crypto debt. And we'll have the 4 asset classes, all crypto, all the time. Now, there'll be a transition. Banks aren't going to go down without swinging, so they're going to try these private blockchains first. Oxymorons like military intelligence, jumbo shrimp. Okay, private blockchain, not a good thing. But people will make some money in the short term over the next decade or so. But ultimately, digital disruption is not new. It's been going on for years. Wealth management. Wealth management still done the same way as 50 years ago. Do you know what the retention rate for when baby boomers pass, what percentage of the kids stay with the broker? 2%. So this person-to-person, good-looking broker, it's just not going to happen. All those Charles Schwab and Merrill Lynch ads, gone. Because the millennials don't care about personal relationships the way we were raised to as baby boomers. They care about things like security, trust. They care about low fees. They care about getting access to their capital and being able to use their capital, not having other people use it on their behalf. So this is the new attack vector for wealth management. $7 trillion is going to pass from the boomers to the millennials. $7 trillion, and that's a big number. And it's all going to be managed in a very different way. This is maybe the biggest opportunity anyone will see in financial services. Because it all has to do with the fact that we are still using 400-year-old technology. 400-year-old technology. We still trade stocks in paper form. People say, no, we have the electronic, we have CUSIPs. A CUSIP is just an alphanumeric representation of a piece of paper that sits at DTCC. And someone has to pay for that paper. I just got a paper certificate of title for my boat trailer. It cost them more to send that to me than the value of my trailer. That's just stupid. Absolutely stupid. There's no reason that we're using the same technology as the buttonwood tree to settle transactions. This is all going to be displaced. Because in the analog age, things are expensive. The markets are local. Okay? There's very little liquidity. You can't have fractional ownership. You can only have physical ownership. Think about the digital age. Nearly zero fees. Global. Right? How many people could buy the Plaza Hotel? 1,000? 2,000? Got to come up with $500 million. Not cheap. How many people around the world would like to own a fractional share of that iconic piece of real estate? Million? 100 million? Billion? Big number. We can do it all with digital securities. So the landscape is changing. The paradigm is evolving. This is not going away. There's no putting the genie back in the bottle. You have to change the way you think. You have to unlearn what you've learned about financial services. You have to unlearn what you've learned about technology, and you've got to embrace this. This is a new asset class. Now, I actually don't like this. Lots of people think about this. I actually don't think it's a new asset class. I think it's a new access class. There's stocks, there's bonds, there's currencies, there's commodities. There's now crypto assets, crypto stocks, crypto bonds, cryptocurrencies, crypto commodities. And so there are a lot of people that say crypto assets are small compared to other asset classes. Again, I don't think of them as a different asset class, but I respect the people who put this stuff together. But this is the biggest boom that we will see in our lifetime. We saw the equity boom. We saw tech equities. We saw commodities and derivatives and securitization, crypto assets, particularly in markets where they need it most. In places like Turkey, in places like Venezuela, in places like Argentina. They will be the early adopters and the winners. Now, one approach is to call it a superclass. I don't like this approach, but I put it up there. The bottom line is, it's the first time in my career, and I've actually been around long enough to have seen a few cycles, first time in my career where an alternative investment actually delivers on the promise. Right? International stocks supposed to be a diversifier, but they're 75, 80% correlated. Fixed income supposed to be a diversifier, but it's 45% correlated and it doesn't have a very high return. Hedge funds supposed to be an alternative asset class, have high correlation. Look at what happened in October. 110% correlated, not a good diversifier, and you haven't gotten the returns for a decade. Now, I'm a big hedge fund proponent. I think it's about to have a great 10 years. But my point is that this is the first time we have an asset that has truly low correlation and delivers high returns. It's the first time in my career that you actually get the free lunch that everybody talks about. And the bottom line is, why? Because stocks and bonds derive their value from profits, economic growth, interest rates, productivity. Crypto comes from network effect. Investor adoption, millennial growth, network growth, regulatory changes in tech. Think about this for a second. Networks don't work the same. 5 of the biggest companies in the world today are not companies, they're networks. Amazon is not a company, it's a network, it's a search engine. They don't produce anything. They link buyers and sellers and take a cut. They take a really big cut, okay? But they are a network. Facebook, network. Apple, network. One cell phone, no value. Billions of cell phones, lots of value. They make a lot of money selling software. Okay? It's a network. Networks grow according to Metcalfe's law, and they are valued differently, and therefore their correlation to traditional assets is going to be 0. That doesn't mean they're perfect. It just means as a portfolio allocator, 10 years from now, you will be in dereliction of your fiduciary duty if you don't have crypto in your portfolio. Full stop. Because you put 1% in to a 60-40 portfolio, your return goes up 500 basis points, your risk goes up 2 points, you get a 23% increase in Sharpe. Put in 3%, the Sharpe goes up 57%. Put in 5%, I'm not even talking 50%, you don't have to go all in, okay? 5%, your Sharpe more than doubles. It's the first time in my career I've seen an asset with deliver on the promise of diversification. So what's the right number? Is it 1%? Is it 3%? It doesn't really matter. You got to get off 0. So hashtag get off 0 is the most important allocation decision that any allocator will make for the next decade. So what did everybody do instead? They all chased after the hot dot. These funds, there are a couple hundred crypto funds last year. They all put up video game returns. I'm up 700. I'm up 900. What are they up this year? Negative 90, negative 70. Okay, that's bad. Howard Marks has this great line. He says, if you want to be in the top 5% of returns, you have to take so much risk that if you're wrong, you'll be in the bottom 5. Never want to be in that place. So don't take that much risk. If you want to be in the top decile over long periods of time, you should shoot to be in the second quartile all the time and never have down periods. So that's where we're going. We're not chasing the crypto guys, the crypto kids. The problem is most of these funds are sub $20 million. They're kids literally under 25 years old. I say that with affection because I have a couple kids of my own. But it's not professional management. This is not where you want to play. You want to play in building out the picks and shovels. Okay? Because the way this works, the way networks work, is you have to lay the groundwork, you have to lay the infrastructure, then you have to lay the software, then you have to get liquidity, and then, and only then, are we going to have the huge companies that are going to come, which are the applications that are created on this technological platform. Remember, the internet was an operating system. iOS and Android is an operating system. Blockchain is an operating system. When Google first came out, 1996, people laughed. The number 21 search engine. Everybody laughed. We put $500,000 when I was at Notre Dame through a firm called Sequoia. We took out $200 million. There should be a quad at Notre Dame called the Google Quad. It was pretty cool. In 2005, I remember when Google bought Android, people laughed at it. What are you buying Android for? 90% of global cell phones today operate on the Android operating system. 90%. As great as Apple is, biggest company in the world, well, at least for now, lost $200 billion in value in the last couple of days. But that company is still one of the biggest, but it only has 10% market share globally. Okay? Android operating system, really important. Blockchain operating system makes both of those look like child's play. Why? Because the mobile net grew on the internet, so its ramp was faster, more exponential. Blockchain grows on top of the mobile net and the internet, and its ramp will be more parabolic. So today we're at 100 billion in Bitcoin, 200 billion in total, and there's this great wallow money, as I call it, that's getting ready. They see the returns, they see it's uncorrelated, they see it's got limited supply, it's sound money, but they're afraid. Why are the institutions afraid? They're tiptoeing in. Yale came in, Notre Dame came in, UNC came in, Duke came in. Why are they tiptoeing in? Okay? Because they're afraid. Custody is a pain. You know, who's going to hold my magic beans? All these exchanges can get hacked. But he says, well, because you got to be with the leaders, you got to be with good technology, and you got to understand where you're placing your bets, and it's all about technological innovation and expertise. Lindy effect, the longer something exists, the less chance there is for it to die, right? So the fact is, the miracle of Bitcoin and crypto was 0.003 cents when the guy bought 2 pizzas for 10,000 Bitcoin. Today you could buy a G5. That was a bad trade. That miracle was going from 0.003 cents to $10. $10 to 100, not a miracle. 100 to 1,000, not a miracle. 1,000 to 10,000, not a miracle. 10,000 to a million, not a miracle. The miracle was the first part of the birth-death cycle. So everyone wants to call it a bubble. How can it be a bubble if only 7% of people in North America call themselves very familiar? Can't be a bubble. We aren't even to the first bust yet. It's 1995. Okay, this is every technology in history. Okay, Bitcoin is on the far right. We have just begun. We're still 6 years, five plus years from the anointment of the blockchain era. Now, cryptocurrencies, there's only a dozen. Everybody says there's 2,000 crypto. No, there's not. Okay? There's a dozen cryptocurrencies. A cryptocurrency is a medium exchange or a store of value. Then there are utility tokens. What's a utility token? It's like Chuck E. Cheese token. So I sell you all Mark coin. I go out and I build a series of arcades. I open my arcades, and I let you come in and knock yourselves out playing with the arcade tokens. What you should have done is said, no, Mark, I want half of the real estate empire you just built with our money. Okay? That would have been better. But utility tokens don't get ownership or share of cash flows. Most of those are going away. 90% of ICOs and utility tokens are going to go to zero. They're pre-seed stage venture, which has a loss ratio of 90%, and they're utility, not store of value or medium of exchange. So to conflate the terms is just wrong, but nobody spends the time to figure out. But crypto securities, security tokens, is the biggest opportunity, again, any of us will ever see in our lifetime. And what it is the difference between a utility token, which gives you access to a protocol or access to a network, versus ownership of an asset, stock or debt, or sharing cash flows. That's what will dominate over the long term. And this is a multi-trillion-dollar opportunity. Because every year, 14 trillion, with a T, dollars of equity, debt, real estate, commodities, and art change hands. Every year, 14 trillion. But that's not even the big part. The big part, $700 trillion, right? I usually have my Bitcoin gold equivalence tie for my friends at Van Eck. Okay, it's got Bitcoin on one side, gold on the other. If we get to gold equivalence, 7.4 trillion, that'd be about $500,000 per Bitcoin. Okay, that's 7.4 trillion. If Bitcoin became the global reserve currency, which I think is possible, not necessarily probable, possible, that'd be 86 trillion. Big number for single Bitcoin. But that's even a piker's number compared to global real estate is 200 trillion. Private companies, another 200 trillion. All of these assets are going to get digitized. Every single one. Every single one. And they're going to trade ubiquitously 24/7. Think about this. The New York Stock Exchange is closed more hours than it's open every week. You can't go to the bank and get a wire done on Sunday. I can transfer Bitcoin instantaneously around the world, 24/7. Western Union charges 12% for me to transfer money across international borders. Why? Because the Rothschilds signed a contract 400 years ago that said 2 banks must always be paid. If money goes across international borders, 2 banks that they own pieces of get paid. That's ridiculous. Now, I'm not saying 0 is the right number, but 12% is the wrong number, and we don't need the banks taken their piece. So James Marshall discovered gold at Sutter's Mill in 1848, right near Sacramento. But he didn't get rich. This guy got rich because James Marshall tried to mine the gold himself. Someone jumped his claim, he lost everything. This guy, Sam Brannan, said, I'm going to buy every pot, pan, pick, and shovel in Yerba Buena, San Francisco, and I'm going to sell it to the miners at $120,000 a day. And he became California's first millionaire. Now, the end of the story, someone pointed out to me, then he married the wrong woman, got divorced, lost everything, and that was bad. But the decisions you made after you're rich don't count. He still made a good decision to get rich. So top venture capital firms in the world today are embracing blockchain. You've heard of these firms like Axel and Andreessen Horowitz. They're actually doing some fun stuff around blockchain. You should too. You have to make a decision. You can choose to do nothing. Right? That's like the ostrich. The ostrich sees the lion come out of the bush. He turns his back. He lays his head on the ground. He doesn't bury it in the sand. That's a wives' tale. He pretends the lion can't see him. The lion still eats the ostrich. The ostrich just doesn't see it happen. So the key is you can ignore this. You can choose to ignore it, and you'll be left in the dust. Or you can make investments in equity around the infrastructure. We like that. You can build a crypto fund, or you can integrate it into your business like Pantera and others have done. Coinbase. Anyone heard of this? Company didn't exist 5 years ago. Did $1 billion of revenue last year. Okay, just got valued at $8 billion with $300 million from Tiger Global, one of the most successful private equity firms in the world. Coinbase has more accounts than Charles Schwab. Coinbase around 5 years, Charles Schwab 40 years. He says, oh, but every account's small. In the first 5 years of Charles Schwab, so are their accounts. This is big, really big. So what this does, it creates a decentralized paradigm. It gives us, the first time ever, the ability to do true peer-to-peer interaction and exchange of value. The same way email transformed information, the same way the mobile net transformed commerce, today we are on the verge of the biggest transformation in our lifetime in value. Within a couple of years, 10% of global GDP will be stored on the blockchain, so it's probably a fad. Blockchain is an ongoing revolution. It establishes trust. It is threatening any middleman, any rent-sinking middleman, and therefore there are going to be a lot of haters. Ignore the FUD, the fear, uncertainty, and doubt, the people that spread, oh, it uses too much electricity. Gold mining uses way more electricity. The banking system uses 1,000 times more electricity than Bitcoin. It's just stupid. So the key is ignore the fear, uncertainty, and doubt. Focus on the tech. Focus on the entrepreneurs. Focus on the talent. This is a global picture of the internet microcosm. You'll notice only 15% of the businesses or the buildings up there are in America. They're all outside. We are a small piece of the blockchain revolution. It's being led by South Korea, by Japan, by Berlin, by places all around the world. And it turns out that not all the smart people are in America. There are smart people everywhere. In fact, we think that there are myriad opportunities, so we've created a venture capital fund that focuses on Bitcoin and blockchain startups. We also created the first digital asset index fund. We want to be the S&P 500 index of crypto, so we partnered with Bitwise to create the first institutional quality index. And I have to show you this slide because for every engineer that graduates in the United States, South Korea graduates 17. For every lawyer they graduate, we graduate 40. They're a country of wealth creation. We're a country of wealth redistribution. Thank you very much.